Hello, good morning and good afternoon to all the participants for Imagia Masterclass. Today's topic is B2B credit management in the new normal. And we have with us our Masterclass speaker, John Salick. As we begin our session, I would like to request you all to do keep in mind that we will have a Q&A session as part of this Masterclass as well. But we are going to take all the questions at the end of the session, post the commencement of the presentation from John Salick. As we progress this session, I'd like to request you to key in any of your questions that you have on the chat window on the WebEx, and we will take those questions sequentially as and when they come in. John, over to you. Thank you very much.
Thank you, Akshay. Welcome, everyone. Got another good program for you today. And I think for those of you who have not kept up closely with the advancements in technology the last year or two, I think you're going to be pleasantly surprised when you learn what's available. We'll focus on the credit management function here. And, as far as not keeping up closely, I mean, that's very understandable. Everyone's got a lot to do. And the advancements have been significant, both in number and in magnitude. So here's a kind of a quick, easy way to get updated. So we're going to just step back. We're talking about technology assisting the credit management function. So we're going to take a step back and just kind of repeat what are the main objectives of credit management and why organizations need it. And then we'll talk about the challenges. And of course, the challenges have changed a little bit, partly because of the pandemic economy, partly for other reasons. So we want to take a quick look at the current major challenges in credit management, and then let's get to the solutions. Artificial intelligence powered digital credit. We'll share with you a case study, which is a nice story of a company that made significant improvements. Recap the benefits for you, wrap it up with a conclusion, and then take any questions you may have. Let's just go back to our 50,000-foot level here and think about credit management. What is the purpose, the need? Well, first of all, it's to control the credit risk and bad debt loss. Notice I didn't say eliminate bad debt loss, because one, that's probably not possible, and two, that's not necessarily the goal. Also, it's to minimize severe AR delinquency and the cash flow penalties that incurs. Most of the focus on credit is bad debt. But if you approve customers and sell to customers on credit who consistently pay well beyond the credit terms, in the aggregate and over time, that's going to take a real toll on your cash flow. And the other side of the coin is to promote revenue. Absolutely. Take risks. Take judicious risks. Sell those accounts. Sell new accounts. Sell accounts that may be riskier than you would like. But that needs to be in accord with the company's tolerance for credit risk. And in my experience, a simple rule of thumb has been companies with a very high gross margin embrace a higher level of credit risk because they can make up the lost profit with a relatively low volume of sales, whereas companies with a very low gross margin have to be more conservative. Because if they absorb a bad debt loss, they will have to sell a lot of volume to make up for it. A great example, worked with a couple of the major pharmaceutical distributors. And essentially their gross margin is 2%. 2%. So if they have a $1 million bad debt, they have to sell an additional $50 million worth of product to just cover that bad debt and break even. Now that's a lot of leverage. So again, promoting revenue, but in accordance with the company's appetite for credit risk. The other side of the coin now is on the vendor side. You have any vendors that might go out of business and interrupt the supply of vital goods and services. And then the other one, given the competitive environment most companies operate in, is to onboard new customers fast, ahead of the competition. And in doing so, you preempt the competition to a large degree. So those are the needs. Probably no surprises here, true nonetheless. So what are the major challenges in pursuing these objectives? Well, we still have and will continue to have, in my opinion, a post-stimulus bankruptcy surge. As the funding is dispersed and spent, there will be companies who will be truly left on their own and will not be able to survive. I think, of the real estate industry, with the eviction moratoriums, eventually they're going to end. And the aid to renters and landlords, most of which hasn't been dispersed yet, but eventually that's going to run out. And there's going to be some landlords who don't survive. So, in the Great Recession, bankruptcies didn't return to their pre-recession level until 5 years after the recession ended. I see a somewhat similar tale here. So the bankruptcy surge, I think an elevated level of credit risk in the economy. So what does that do? Well, it triggers an increased workload. You got to monitor that credit risk more closely and more frequently. Most of the clients I worked with for their existing companies, they would refresh the credit limit once a year for the majority of their customers. Well, for a lot of customers now, that probably has to be done a little more frequently, maybe twice a year. That's additional work. And that work for a lot of companies is going to have to be done in a work from home and paperless environment. Nothing wrong with that if you can handle it. If you can't handle it, then it's a challenge. The customer expectations continue to grow every year for fast processing and order fulfillment. That's the internet economy. Mentioned a little bit about the vendors in the prior slide. You need to ensure a supply of key materials and services. And if one of your key suppliers goes bankrupt, that can put a real crimp in your operations. So, what is the challenge? What is the requirement? Credit management has to be good and fast. Easy to say, not so easy to deliver. And just to elaborate a little bit more on the challenges, this shift to e-commerce, the face-to-face contact, I don't want to say it's a thing of the past, but it's decreased substantially. Websites are now the major customer interface. Online ordering is kind of the channel of choice. And again, customers expect it all to be fast and easy. And if you are slow to vet your new customers and slow to come to a credit decision, those potential customers could very well go somewhere else. And as always, any order hold decisions and actions need to be taken quickly. And all that expectation for speed has been heightened with the shift to e-commerce. But with challenges come opportunities. One opportunity is creating competitive advantages. Now remember, your competitors lost business during the pandemic economy, and they're looking for new customers as much as you are. How can you beat them? Well, one way is a fast quality credit vetting process. Because if you can prove a customer before your competitors and start supplying them, in most cases, you're going to secure a good share of that sales volume and preempt your customers from being the primary supplier or even the secondary supplier. I mean, customers, on the procurement side for years now, there's been a movement to centralize and reduce and concentrate suppliers. I think that's unraveled a little bit in the last year. Now they're looking for, well, maybe not one supplier, maybe we'll have two or three. But anyway, beyond that, there it doesn't make sense to have a lot of suppliers. So having a quick credit vetting process increases your chances of being in that one or two or three suppliers to a company. So we say fast. Well, how fast is fast? Well, Hackett's benchmarks say world-class performance is 2 days. And that's 2 days of elapsed time, not work time. So that's pretty quick. That's pretty quick. And the old drag racing saying speed kills, well, it does. Kills the competition. All right. So those are the challenges. What are the solutions? Easy to recite problems and challenges, but what's needed is solutions. Well, there's a combination of technologies, sometimes referred to as AI-powered digital credit, which comprise a solution. Won't get into too much of the technology, but when we talk about AI-powered digital credit, it utilizes artificial intelligence with its cognitive self-learning features, natural language processing, which is very important to interpret text and voice. They integrate well with most major ERPs. That's one of the nice features, is the integration is not a big problem, which is important because remember, your ERP is your primary order fulfillment tool, and on the accounting and audit side, it's the single source of the truth. So you need to be integrated with that ERP. And then the AI-powered digital credit also manifests itself in what's called digital assistants, which emulate human beings. And they assist your workforce. They can provide information to management. They can field queries. What were our sales in Missouri in the second quarter of last year? Boom, digital assistant can do that. Can also, perhaps most importantly, engage and assist customers. Customer goes to your customer portal, looks at their statement and say, oh, geez, I got some past due invoices. I should pay them. Let me pay them right now with a debit card, credit card, ACH, whatever. Not quite sure how to do it. I need help. Well, there's a chat box there. There's a robot there a digital assistant that can help them. And then also importantly is performance of repetitive tasks. And that's where the productivity comes in. And that's where taking some of the drudgery out also comes in. And the benefits, fast credit decisions, automation. If it's an entirely manual credit operation, the automation can affect 70 to 80% of the work, reduce 70 to 80% of the work, and ultimately better credit decisions. Because once the data is accumulated and arrayed properly, and a credit score and recommended credit limit computed, then the human beings, the experts, the credit managers, the credit analysts, can then spend a little more time on weighing the qualitative factors and assessing the risk. So it fits a lot of needs. Now let's talk about some of the enablers or capabilities of artificial intelligence digital credit. Certainly, as we talk about this, you'll see how they improve productivity and speed, but also accuracy. They don't make human errors. So it starts with the credit app. The credit application, great. It's customizable, so you can ask or not ask for whatever you want. For example, if you're a credit manager that just doesn't put a lot of credence in trade references because the applicants only can give you trade references that they pay on time, you can eliminate that from your credit app. Or in the credit scoring, you can give it a very low weighting. So you got this customizable credit app that's online. So the customer downloads it, completes it, and submits it. You always want that signature. Well, it accommodates digital signatures. Very nice. And certainly speeds things up. And then the digital assistants import the information required for credit vetting from your credit bureau, whether it be Experian, Dun & Bradstreet, whomever. And if it's an existing customer whose credit limit you're re-evaluating, it can import the payment history, which is a critical input for existing customers. And then it will automate the credit scoring. And again, you can select the factors for the scoring and weight them the way that makes the most sense to you, like my example of trade references a few minutes ago. And then it can even make credit decisions based on predefined rules and recommend a credit limit, subject to human review, at least for the larger credit limits. But all this work is getting done fast. And then certainly for the higher credit limits that require more than one approval, more than one signature, the AI digital credit assistants operate a full-featured workflow you can configure to your delegation of authority policy. Whoever needs to see it and approve it, and what the sequence is, it's routed and forwarded automatically. And then certainly the automatic credit limit update process, whether it's annually, every 6 months, every 2 years, whatever, that's all triggered automatically. Customer comes up for credit review, the information is gathered, and the credit score is assigned, a credit limit is suggested, and it's all ready to go. You know, most of the 250, 300 clients I worked with never kept up on their credit limit refreshment. They're always behind. You ask them, when do you review the credit limit? Oh, once a year. Well, how you doing? Well, a little behind, not quite got to everyone we should. So this capability certainly helps that. And it reinforces the automatic order hold and can improve the speed of response there. And then, if you want to just keep your tabs on the whole credit risk management activity, you can design a scorecard to measure the inputs, the outputs, the credit applications received, credit applications finished, credit applications in progress, how many, how old, things like that. And then nicely too with the analytics modules, you can get a pretty good feel of what's the aggregate credit risk of my portfolio. I've got 80% of my AR is owed by low risk customers, 10% from medium risk customers, 10% from high risk, or something better or worse than that. I mean, that's a nice fact to know. So I think, at this point, the advantages are probably becoming pretty obvious. Just, again, to reemphasize a couple of points. We talk about time saving. Well, it's both elapsed time and work time. And having this online credit application that the potential customer cannot submit unless they've filled out the required information is a big time saver. Because you ask for a credit app, they send it in, they didn't complete everything, so you got to go back and say, oh, you really need to fill in rows 8, 12, and 15. So they fill out 8 and 12, send it back. You say, well, I hate to be a pain in the neck, but you got to fill out row 15. We need that information. All this takes time, and it eats up labor, the back and forth. That's all handled. Can't be submitted unless the required elements are completed. And again, the automated gathering of information from different sources. Another nice feature is verifying information. verify the business licenses, the sales and use tax, resale certificates, tax numbers, federal ID tax numbers. Are they on the OFAC list? And then, as I mentioned earlier, automatic credit scoring and an automatic credit, I say decision, it's really a credit limit recommendation to be approved. And again, for a credit operation that's entirely manual, you can see 70 to 80% of the work be automated and, quote, go away. So let's share a case study, a company that utilized these capabilities and what it did for them. They're a supplier of building materials. And if you're familiar with this marketplace, the customer base is contractors and developers. And to put it politely, this is a customer base that is thinly capitalized. They ain't got no money. So it's up to the supplier to provide that trade credit to keep them going. That's kind of the reality of things. So they need to provide this financing. But of course, you need to manage the credit risk as well. Their existing system wasn't cutting it. They're on a rapid growth path as they had introduced some new products that the market was reacting very positively to. So what did they do? Well, they deployed Homage's digital credit solution, including in there is one, you see it in parentheses there, is that online credit app. There's a separate website for it called thecreditapplication.com. I'd urge you to visit that because it's really high value and it's something you can acquire at no charge, and it's a good first step towards digitizing your credit vetting. So, digital credit app integrated their credit bureau is Experian. They had an analytical tool from NetSuite, so they're able to automatically score applicants and suggest a credit limit. Verified the resale certificates, which is important because these customers are saying they're tax exempt, sales tax exempt. So, well, I need proof. Otherwise, I'm going to be paying big fines a couple of years down the road. And here, in this case, automated around 80% of the credit vetting process. And then this next fact, this is the proof of the pudding. The time span or the cycle time for a credit app was reduced from 14 to 4 days. And again, that's elapsed time. So, that's a huge improvement. And when you talk about preempting the competition, well, if you're turning around credit apps in 4 days, you're preempting some of the competition, maybe a lot. Now, they're not at Hackett's 2 days yet, but they're getting close. They're getting close. So, wrap up quickly here. What are the benefits? Well, faster turnaround of the credit apps, which can enable you to onboard customers faster. Increased productivity can be a nice increase in productivity, or it can be a huge increase in productivity, depending how manual your current credit operations are. And at a more strategic level, it enables you to maximize revenue within the credit risk parameters with a controlled credit risk because you're better informed. And it enables straight through processing of e-commerce orders. Once you get those customers, you get a new customer, you get it set up quick, the orders can flow. So you start at the bottom here, this value chain, you start with a better customer experience, controlling, not eliminating, controlling that credit risk will lead to greater cash flow, ultimately higher revenues and higher profits. So what's our conclusion? We mentioned earlier, the first few slides, the challenges, right? And they're significant. And the solution is a faster, effective credit risk management capability, and really can't see that happening without significant automation. The market is moving towards this AI-powered digitization to deliver the capabilities required to succeed in today's market. questions.
Thank you very much, John. Before we get started with the questions, I'd like to request the audience again to post in your questions on the chat window that we have all got here, and we'll take those questions. So, John, we've been talking about the credit risk management and all, right? I mean, but there have been a lot of challenges that we have seen in the past. But what do you think are the major new challenges with respect to credit risk management?
Well, one, I think it's the elevated credit risk in this, I was going to say post-pandemic economy. It's probably not accurate anymore. Pandemic economy. So the elevated credit risk, the need for speed, the customer expectation, it's there. Those are two of the major challenges and market requirements out there.
Right. And with the growing digital assistants, right, the AI-powered digital assistants in credit risk management as well, what would be the most valuable capabilities that we could expect out of AI-powered digital assistants?
Yeah, well, it's a little hard to choose, but my personal favorite is that online credit app. I mean, boy, that eliminates a lot of non-productive time and action. And to be honest with you, it kind of pushes the responsibility for submitting a complete credit application onto the prospective customer, not inside your department. So that's a big one. I think the automation in gathering the credit bureau information, the bank references, the trade references, putting that together, doing an automated credit scoring, taking that score, combining it with the estimated sales requirements and recommending a credit limit. Those are three very valuable capabilities.
Thank you, John. And let me take another question here. So, what do you think would be the potential labor benefits, right? I mean, because we are looking at AI digital assistants, so what kind of a labor savings are we going to be looking at?
Well, now you're talking to a guy who started in credit when you had to fill out a order form, mail it to Dun & Bradstreet, and then they would mail the credit report back. Cycle time about 2 weeks. So I may be more appreciative of the speed and labor saving than many people, but you know, the value comes in the speed and the reduction of work. So if you're completely manual, we would see productivity improvements of 70 to 80%. The case study that I cited, they had seen an 80% improvement. So now if you're more automated, you've got some of these capabilities already, certainly the productivity is going to be less. But even if it's 20, 25%, I mean, where else are you going to get 25% productivity? So that's some real value and some real nice potential there.
Yeah, that means a lot to businesses, right, John?
Absolutely.
Thanks a lot very much, John. We're just about on the nick time, top of the hour here. So I would like to thank all the participants over here for joining us for our masterclass, and wanted to also invite you for our next session, which is going to be on 9th of September, again a Thursday at 10 a.m. Pacific. The topic for our next masterclass is digital world-class performance of how-to-cash shared services, and we look forward to seeing you all there. In the meanwhile, if you do have any questions, do write to us at info@imagia.com. We'll be more than happy to take those questions and revert back with our responses. And
Yes.
thanks a lot, John. Thank you very much for our session again today. And we look forward to our next masterclass on 9th September.
My pleasure. And again, folks, if you do have a question that you think of later today, tomorrow, next week, or whatever, just send it in. Happy to answer them. And certainly answer it in respect to your individual company situation as well.
Sure, definitely. I will be delighted to have any questions that you might have. Thank you very much. Thanks, John.
All right. So long, everyone. Thanks for attending.